Learning to read Forex charts is a fundamental skill for any aspiring trader. These charts are graphical representations of a currency pair's price over time, with price on the vertical, y-axis, and time on the horizontal, x-axis. By analyzing Forex charts, traders can visualize market movements, identify trends, and spot patterns that may signal future price direction. In this guide, which is aimed at beginners but also introduces intermediate concepts, we'll walk through the main types of Forex charts and how to interpret them like a pro. We'll also cover essential chart features, time frames, price axes, and technical analysis tools, like support resistance lines and moving averages that experienced traders use. Whether you're using popular platforms such as TradingView or MetaTrader 4-5 in light mode, mastering chart reading will give you a significant edge in understanding market behavior. Are you ready to trade with confidence? Join XM, the trusted Forex and CFD broker with over 10 million traders worldwide. Experience ultra-fast execution, tight spreads starting from zero point 0.0 pips, and no hidden fees. XM gives you access to over 1,000 instruments, Forex, stocks, gold, oil, crypto, and more. Whether you trade on MT4, MT5, or mobile, XM's technology keeps you one step ahead of the market. Start small or go big. With XM, your success is powered by transparency and speed. Click the link in the description and open your XM account today. Trade with confidence. A Forex chart is simply a visual price chart that shows how the exchange rate of a currency pair changes over time. The chart's y-axis represents price, exchange rate, while the x-axis represents time, ranging from short intervals, minutes, hours, to longer periods, days, weeks, or months, depending on the selected time frame. Each data point on the chart reflects the price of the currency pair at a given time. For example, on a 1-hour chart, each point, or bar candle, shows the price action for 1 hour. On a trading platform, you can usually select the time frame of the chart, e.g. 5-minute, 1 hour, 1 day. This determines how frequently new price data is plotted. Short time frames, like 1 min or 5 min, will show very granular price movements, while longer time frames, like daily or weekly, smooth out the noise and highlight broader trends. Traders often begin by identifying the currency pair, such as EUR, USD, or GBP JPY, and then examine the price and time axes to understand where the market is and how it got there. It's important to note that a Forex chart aggregates all the buying and selling activity for that pair. Price changes reflect shifts in supply and demand, influenced by news, economic data, and trader sentiment. By reading these charts, you're essentially seeing the collective psychology of the market plotted in real time. Forex prices can be visualized using different chart types. The 4 main chart styles are line, bar, OHLC, candlestick, and area, mountain charts. Each type presents price data differently, and understanding all of them will help you choose the best view for your analysis. Among these, candlestick and bar charts are the most popular for Forex trading because they display more information than a simple line or area chart. Let's explore each chart type and how to read them. A line chart is the simplest form of price chart. It plots a series of closing prices and connects them with a continuous line. In a line chart, only the closing price for each period is shown, ignoring the open, high, and low prices. The result is a clean, easy-to-read line that shows the overall price trajectory, trend, over time. Line chart example: a simple line chart for EUR/USD, plotting only the closing prices over several months. Notice how the blue line provides a clear view of the overall trend, without showing intra-period highs and lows. Line charts are great for getting the big picture of a market. For instance, if EUR/USD has been steadily rising over months, a line chart will clearly display that upward trend. By focusing only on closing prices, short-term fluctuations are smoothed out, making long-term trends more apparent. However, The drawback is that you lose information about intraday volatility. You can't see how high or low price went during each period or where it opened. Because of this, many traders use line charts primarily for high-level trend analysis or to compare closing prices over time, rather than for precise entry/exit decisions. A bar chart, often called an OHLC chart, open, high, low, close, or HLOC, provides more detail than a line chart. Each period is displayed as a vertical bar with small horizontal ticks on the sides, encapsulating 4 key data points: the period's open, high, low, and close. Here's how to read a single price bar. Open price, indicated by a small tick mark to the left of the vertical line. This is where the price started during that period. Close price, a small tick mark to the right of the line, where price ended the period. High price, the top of the vertical line, the maximum price reached. Low price, the bottom of the vertical line, the minimum price reached. If the close is higher than the open, the bar is often colored green or another bullish color, indicating the price rose during that period. If the close is below the open, the bar might be colored red, price fell during that period. This color coding helps you instantly see whether the period was up or down. Bar chart. Example, OHLC, each bar shows the open, left notch, close, right notch, high, top, and low, bottom for that period. Green bars indicate a period where price closed higher than it opened, while red bars indicate the opposite. Bars with longer lines denote higher volatility in that period, larger range between high and low. Bar charts allow you to gauge both price direction and volatility at a glance. For example, a series of long bars implies a period of high volatility, big price swings between the period's high and low. If many bars are green and climbing, buyers have been in control. If many are red and descending, sellers are dominating. Additionally, where the close sits relative to the bar's range can indicate market sentiment. A close near the top of the bar suggests strong buying pressure during that period, whereas a close near the bottom suggests selling pressure pushed the price down before the period ended. The candlestick chart is the most widely used chart type among professional Forex traders, as it conveys a wealth of information in a visually intuitive format. Candlestick charts originated from Japanese rice traders centuries ago and are now standard in trading platforms. Each candlestick, candle, represents the same 4 data points as an OHLC bar: open, high, low, close, but in a stylized form that looks like a candle with wicks on both ends. A typical candlestick consists of a body, the rectangular part of the candle, spanning from the open price to the close price, wicks, or shadows, thin lines above and below the body, representing the high and low prices reached during the period. The body is usually colored green or white if the price closed higher than it opened, bullish candle, or red or black if it closed lower than it opened, bearish candle. This color scheme gives instant visual feedback. Green candles mean the market moved up in that period. Red candles mean it moved down. The length of the body shows how large the price move was: long body, big move, short body, small move, and the wicks show the extremes of price action. Long wicks indicate that price moved far up or down within the period, but then retreated before closing. Candlestick chart. Example: a series of candlesticks showing price action. Each candle's body is green if the close is above the open, price rose, or red if the close is below the open, price fell. The thin wicks mark the intra-period high and low. Notice how candlesticks convey more info than a line chart. For example, the tall green candle with no upper wick signifies strong buying with the price closing at its high, whereas a candle with a long upper wick, shadow, indicates that price was pushed back down from a high level before close, revealing possible resistance or selling pressure. Candlestick charts not only show trend and volatility, but also form specific candlestick patterns that traders interpret for signals. A long-bodied candle, especially with little or no wicks, indicates strong momentum in one direction. E.g., a long green candle means buyers dominated that period. A candle with a small body and long wicks on both ends signals indecision or a tug-of-war between bulls and bears. For instance, if price went high and low but closed near where it opened, neither side won control by the end. A doji is a special candlestick where the open and close prices are virtually equal, forming a cross or plus sign, very tiny body. A doji reflects market indecision. Buyers and sellers were evenly matched. By itself, a doji is neutral, but if one appears after a strong uptrend or downtrend, it can hint that the trend is losing momentum and a reversal might occur. Pros will look for confirmation on subsequent candles, however, before acting on a doji signal. There are many candlestick patterns, like hammers, shooting stars, engulfing patterns, etc., that you can study as you advance. These patterns, composed of one or several candles, can provide early clues about potential trend reversals or continuations. For example, a hammer, a candle with a small body and long lower wick, after a downtrend may signal a bullish reversal, as it shows sellers push the price down, but buyers drove it back up to close near the high. A bullish engulfing pattern, a small red candle followed by a larger green candle that engulfs the prior range, suggests a shift from selling to buying pressure. While we won't cover all such patterns here, being aware of them is part of reading charts like a pro. Seasoned traders recognize these candlestick clues and incorporate them into their decision-making. An area chart, also called a mountain chart, is essentially the same as a line chart, but with the area under the line filled shaded. This makes it look like a mountain silhouette. Area charts are used similarly to line charts. They emphasize the overall price trend over time by focusing on closing prices and smoothing out intra-period fluctuations. The filled area can make trends stand out visually for presentations or reports. However, like line charts, area charts do not show opens, highs, or lows. Because of this limitation, traders typically use area mountain charts only for a quick, long-term overview or when comparing multiple assets, since the filled areas can be visually stacked. For most trading decisions, candlestick or OHLC charts are preferred due to the richer detail they provide. When reading Forex charts, context is everything, and time frame provides context. The time frame of a chart dictates the length of time each bar or candle represents. Common time frames include 1 minute, 5 minutes, 1 hour, 4 hours, daily, weekly, etc. For example, on a 4H chart, each candlestick shows 4 hours of price action, whereas on a daily chart, each candlestick represents an entire day's worth of trading. Selecting different time frames can drastically change your perspective on the market's behavior. Short time frames. Intraday. Charts like 1 minute, 5 minute, or 15-minute highlight very short-term price fluctuations and are often used by day traders or scalpers. These charts will show a lot of noise, random back-and-forth price movements, because they capture every minor tick. Short time frames are useful for timing precise entries and exits, but trends seen here may not last long. For instance, a currency could look like it's trending down on a 5-min chart, while still being in a broader uptrend on a daily chart. Longer time frames. Charts like daily, weekly, or monthly filter out the minor intraday swings and emphasize the broader trends. A daily chart might show a smooth uptrend that is composed of many smaller pullbacks and rallies that would be evident on an hourly chart. Long-term investors and swing traders often start their analysis on daily or weekly charts to identify the major trend, then zoom in to lower time frames to fine-tune their trading plan. Many experienced traders combine multiple time frames to get a comprehensive view. For example, a trader might check the weekly chart to see the big picture trend, say EUR/USD is in a multi-month uptrend, Use the daily chart to spot key support and resistance levels within that trend, and then drill down to a 1-hour chart to pick an ideal entry point, perhaps waiting for a short-term pullback to support in the context of the larger uptrend. This is often called a multi-time frame analysis. By cross-referencing charts, you ensure that what looks like a good opportunity on a 15-minute chart isn't going against the grain of the dominant daily trend. When reading charts like a pro, always be mindful of the time frame you're examining. A price pattern or signal on a very short chart may carry less weight than one on a higher time frame. Pros typically give more significance to signals on longer time frames, e.g., a breakout on a daily chart is more meaningful than a breakout on a 5-minute chart because they reflect larger market participation. In summary, timeframes add perspective. Use multiple views to confirm what the market is doing across short-term and long-term horizons. Beyond just looking at raw price bars or candles, professional traders apply technical analysis tools to their charts to aid in interpretation. These tools can help identify potential support resistance levels, trend strength, and momentum. Below, we'll discuss a few of the most essential chart tools: support and resistance lines, trend lines, a related concept, moving averages, and the relative strength index, RSI. Using these in combination with price action helps traders make more informed decisions. In any price chart, you'll often notice certain price levels where the market has a tendency to stop and reverse. These are known as support and resistance levels. Support is a price level, typically a horizontal line drawn along prior lows, where buying interest is strong enough to prevent the price from falling further. In other words, it's a floor where the down moves repeatedly find support and bounce back up. Resistance, on the other hand, is a level drawn along prior highs, where selling pressure tends to prevent the price from rising further, acting as a ceiling that price struggles to break above. Traders draw support lines along significant lows in the chart, where price dipped but then rebounded, and resistance lines along significant highs, where price rallied but then fell back. These lines help highlight areas where the price has repeatedly reversed or paused in the past. The idea is that these price zones could again influence the market. For instance, if EUR/USD has bounced off 1.1000 multiple times in the past, that level is a strong support. If it has failed to break above 1.1200 after several attempts, that's a notable resistance. Support and resistance example: a candlestick chart identifying key support and resistance levels. The blue dashed lines mark minor resistance levels, where the price rose and turned down, peaks, and a minor support, where price dipped and bounced. The blue solid line at the bottom marks a strong support zone that has been tested multiple times. Notice how the price touched this level several times and could not break below. Traders watch these levels closely. When price approaches a support or resistance, it often either reverses again, or if it breaks through, that breakout can lead to a sharp move. Support and resistance work because of trader behavior. Many participants remember these key levels. For example, if GBP USD has a known support at 2000, buyers may step in around that price because they expect a bounce or want a low-risk entry with that support as a floor. Similarly, sellers might line up near a known resistance to take profits or open short positions. When price does approach a strong support shot resistance, you'll often see the battle between bulls and bears intensify, leading to either a reversal or a decisive breakout. If price bounces off a support level yet again, it confirms that level's validity. Each touch and bounce can strengthen the support. It shows buyers are consistently active there. The same goes for resistance. If price breaks through a significant support or resistance, it can signal a notable shift in supply-demand. A broken support can turn into a new resistance as traders who bought at that level may exit on rallies, This is called role reversal. And a broken resistance can turn into support as sellers turn into buyers on pullbacks. Identifying support and resistance is a basic but crucial part of chart reading. Pros will often plot multiple horizontal lines to map out the field in which the market is playing. Keep in mind these levels are often zones rather than precise lines. Price might overshoot a bit before reversing. Combining support-resistance analysis with candlestick patterns can provide powerful insights. For example, a bullish candlestick pattern right at a long-term support level is a stronger signal than the pattern alone. Note: along with horizontal support-resistance, traders also draw trend lines, which are like sloping support or resistance lines along an uptrend or downtrend. For instance, connecting successive higher lows in an uptrend gives you an ascending trend line that can act as support. A break of a long-held trend line can signal a trend change. Trend lines are another tool pros use to gauge the health of a trend and potential reversal points. A moving average, MA, is one of the most commonly applied indicators on Forex charts. In essence, a moving average calculates the average closing price over a specified number of past periods and plots that value as a line on the chart. For example, a 50-day simple moving average will sum up the last 50 daily closing prices and divide by 50. This average is then plotted for each day, creating a smooth line that moves as time progresses. The MA is a trend-following tool that smooths out price fluctuations to help reveal the underlying trend direction. Traders use moving averages in several ways. Trend identification. If the price is largely above the moving average line and the MA line is sloping upward, the market is likely in an uptrend. Conversely, price below a downward sloping MA indicates a downtrend. For instance, price staying above a 50-day MA often signals an overall uptrend, while sustained price below it signals a downtrend. Dynamic support and resistance. Moving averages can act as support or resistance themselves. In an uptrend, dips often bounce off the moving average because many traders watch and buy near the MA, and in a downtrend, rallies may stall at the MA. Crossover signals. Some traders use multiple MAs, e.g., a 50-day and a 200-day. When a shorter-term MA crosses above a longer-term MA, a golden cross, it's viewed as a bullish sign. A cross below, a death cross, is bearish. These are more of a longer-term signal, though, commonly applied to daily charts. Moving average example, the chart above shows candlesticks with an overlaid moving average line, orange line. The MA smooths out the price and makes the trend clearer. Notice how when price is above the moving average and the line is rising, the market is in an uptrend. When price falls below and the line turns down, a downtrend emerges. Traders often use moving averages to identify trend direction and as floating support or resistance. For example, the price in this chart repeatedly pulls back toward the moving average, orange line, and then bounces higher, indicating the MA acting as a support during the uptrend. Common moving averages used by Forex traders include the 50 period and 200 period, very popular on daily charts for identifying medium and long-term trends, as well as shorter ones like 10 or 20 for short-term trading. Moving averages filter out the noise of daily price swings and help you stay focused on the bigger trend. However, they are lagging indicators based on past prices, so they work best in trending environments and can give false signals in choppy, sideways markets. The Relative Strength Index, RSI, is a popular momentum oscillator that helps gauge whether a market is overbought or oversold. RSI is plotted separately, typically below the price chart, as a line that oscillates between 0 and 100. Classic interpretation is that RSI values above 70 suggest an overbought market. Price may have risen too far, too fast, and could be due for a pullback, while values below 30 indicate oversold conditions. Price may have fallen too fast and could bounce. RSI is calculated based on the magnitude of recent gains versus losses in closing prices. Without diving into the formula, its real utility to a chart reader is Identifying momentum shifts. If price is making new highs but RSI is not, diverging lower, it could warn that the upward momentum is weakening, bearish divergence. The opposite, price makes new low but RSI makes a higher low, can signal a bullish divergence. Confirming trends. During strong uptrends, RSI often stays above 50 and frequently hits the overbought region, 70. In downtrends, RSI often stays below 50 and can remain in oversold territory for extended periods. So context matters. Overbought readings in a robust uptrend might just mean strong momentum, not an immediate sell signal. While we won't embed an RSI chart here, imagine below the price chart a line that flutters up and down. When that line crosses above 70, you'd be cautious that the rally might be overstretched. When it's under 30, you'd watch for a potential bottoming out or reversal upward. Many traders use RSI in conjunction with price patterns. For example, if a currency pair is testing a resistance level and RSI is above 70, overbought, that confluence might strengthen the case for a pullback. Summary of tools. By combining price action analysis, candlesticks, chart patterns, etc., with tools like support, resistance, trend lines, moving averages, and RSI, you form a more complete picture of the market. Technical tools highlight key price levels and the strength of price moves, allowing you to trade with greater confidence. Always remember that these tools are aids. The price itself, what the chart is doing, is paramount. Tools help interpret the price behavior, but they're not crystal balls. Professionals often say, trade what you see, not what you expect, meaning react to the chart and use indicators as secondary confirmation. As you gain experience, you'll start recognizing distinct chart patterns that repeat over time across currency pairs. Chart patterns form as a result of the market's natural rhythm of trending and correcting, and they can provide insight into potential future direction, though not guarantees. Knowing a few of the most common patterns is a key part of reading Forex charts like a pro. Patterns are typically identified on bar or candlestick charts since you need the detail of swing highs and lows. Here are some well-known chart patterns and their typical interpretations. Head and shoulders. This pattern looks, as the name suggests, like a head with two shoulders on either side. It occurs after an uptrend. The left shoulder is a peak, the head is a higher peak, and the right shoulder is a lower peak, roughly in line with the left shoulder. A neckline is drawn under the two intervening lows. When the price breaks below the neckline, it signals a potential trend reversal from bullish to bearish. In essence, the pattern indicates the uptrend weakened, right shoulder couldn't reach the height of the head, and a break of support, neckline, confirms sellers taking control. Head and shoulders pattern schematic. This diagram shows the classic head and shoulders. The market makes one high, left shoulder, a higher high, head, then a lower high, right shoulder, indicating waning bullish momentum. The break below the neckline, drawn under the shoulder lows, completes the pattern and often leads to a bearish reversal. These patterns feature two consecutive highs or lows at roughly the same level, creating a shape like the letter M for a double top or W for a double bottom. A double top often signals that the uptrend has hit a ceiling twice and is unable to break through, indicating a potential bearish reversal. The pattern is confirmed when price falls below the interim low between the two tops. Conversely, a double bottom shows two failed attempts to push price lower at a support area, suggesting a bullish reversal upward when price breaks above the interim high. Wedge. A wedge is a pattern where price action is contracting. The trading range narrows between two sloping trend lines. If both lines slope upward, a rising wedge, or both slope downward, a falling wedge, the lines converge. Wedges can signal either bullish or bearish outcomes depending on direction of breakout, but generally, a rising wedge, sloping up, tends to be bearish, especially if it forms after a large up move. It indicates momentum is slowing. higher highs and higher lows at a diminishing rate, and can break downwards. A falling wedge, sloping down, tends to be bullish, often occurring at the end of a downtrend as selling momentum wanes. The key is the slope and breakout. Wedges basically show consolidation where bulls and bears are in a tightening battle. Flag and pennant. These two are short-term continuation patterns that often appear after a sharp, strong price movement, sometimes called a flagpole. A flag looks like a small rectangular consolidation that slopes against the prior trend, e.g., a slight downward channel after a strong rise. A pennant is similar, but with converging trend lines, like a tiny symmetrical triangle. Both indicate the market is catching its breath after a big move. When price breaks out of the flag or pennant, usually in the same direction as the preceding move, the prior trend often resumes. Triangles: symmetrical, ascending, descending. Triangles are very common patterns where price range contracts over time. Symmetrical triangle: lower highs and higher lows converge toward a point. It's a neutral consolidation. Price could break out in either direction. Traders watch for volume and other clues to see which way it will go. Ascending triangle: flat resistance on top, rising trend line of higher lows on the bottom. This usually indicates mounting buying pressure. It's often a bullish pattern that breaks upward once buyers finally overpower the resistance. Descending triangle: flat support on the bottom, descending trend line of lower highs on top. This typically indicates growing selling pressure and often breaks downward once support gives way. Triangles reflect consolidation phases where the market is coiling before a likely breakout. Traders often anticipate the breakout direction by noting whether buyers or sellers are more aggressive, e.g., ascending triangle favors an upside break. These patterns give traders a framework for anticipating what might happen next. For example, spotting a head and shoulders at the end of a long uptrend would alert a pro trader to tighten stops on long positions, or even consider short opportunities if the neckline breaks. Seeing an ascending triangle form during an uptrend would prepare a trader to buy the breakout if resistance is cleared. It's crucial to remember that no pattern is 100% reliable. They indicate possibilities, not certainties. That's why confirmation and risk management are important. Many traders will wait for a confirmed breakout from a pattern and even a retest of the broken level, e.g., price breaking above a triangle and then coming back to touch the old resistance as new support, before fully committing to a trade. Moreover, combining patterns with other analysis improves odds. For instance, if a double bottom forms right at a long-term support and RSI shows oversold, multiple factors align for a potential bullish reversal. In summary, reading chart patterns is like learning to recognize recurring pictures in price behavior that often precede certain outcomes. As you study historical charts, challenge yourself to spot these patterns. Over time, you'll get a sense for which patterns are most common or reliable for the Forex pairs you trade. Incorporating pattern analysis with candlesticks and technical indicators is a hallmark of advanced chart reading. By now, we've covered a lot of ground, from basic chart types and axes to advanced patterns and indicators. Reading Forex charts like a pro involves synthesizing all this information into a coherent market view. Start with the basics. Identify the current price relative to historical prices. Is it near highs, lows, in a range? Note the trend on higher time frames and mark key support, resistance levels. Analyze the chart type that suits your needs. Candlesticks for detailed price action, the preferred choice for most pros, line charts for clarity on trend, etc. Recognize candlestick signals, reversal candles, indecision candles as they form. Layer on technical tools. See where the price is in relation to moving averages, trend strength. Check momentum via RSI or similar if applicable. Draw trend lines and channels, and be aware of any divergence between price and indicators. Look for patterns or setups. Is there a breakout building up? Any classic pattern like a triangle or head and shoulders forming? Combine that with what the indicators and candle behavior are saying. Ultimately, practice and experience are what turn an aspiring trader into an expert chart reader. It's recommended to review many historical charts and even replay them, calling out what you see, e.g., there's a support at this level, price formed a hammer candle here, and bounced, then broke above a consolidation, a bullish sign. Over time, your eyes will catch important details almost unconsciously. Keep in mind that professional traders also stay aware of the bigger picture, economic news, central bank policy, market sentiment, which can all influence what you see on the chart. For example, a perfect head and shoulders might be developing, but if a major Fed interest rate decision is due, the pattern could easily be invalidated by a news-driven spike. So, context matters beyond just the technicals. In conclusion, reading Forex charts like a pro means understanding the story that price is telling. Every bar, candle, and pattern is information about how buyers and sellers are interacting. By mastering chart types, timeframes, and technical tools, and by recognizing patterns and key levels, you equip yourself to interpret that story accurately. Finally, never stop learning. The markets are dynamic, and even the best traders continue to adapt their chart reading skills. Use demo accounts or chart replays to test your analyses and learn from each trade, win or lose, what the chart signaled in hindsight. With dedication and experience, you'll be able to glance at a Forex chart and quickly discern its state, trending or ranging, its bias, bullish or bearish, and potential opportunities. That ability is the essence of reading Forex charts like a true professional.